So I titled this video, Day Trading Gurus Are Lying to You, and that's because one of the most common pieces of advice that day trading gurus, people on YouTube give you, I found that this is actually really bad advice, and I guarantee you this is hurting your trades. This is hurting your win rate. This is causing you to take way more lower probability setups and get stopped out and have just more red trades overall. So what I want to do is show you exactly what that one piece of advice is. Then I'm going to show you why it's bad advice with proof. All right, so anyways, guys, super excited to share this with you. I think this concept will help a lot of you out in your day trading. So that being said, let's dive straight into the video. All right, so that one piece of advice I'm talking about that you hear so many traders actually give you, and you know, I used to listen to this too. And once I stopped listening to advice and I literally started doing the opposite, my win rate went way up and I started being way more of a profitable trader. Okay, so what that advice is they'll always tell you only take low risk trades. Focus on your risk to reward ratio. Your risk to reward ratio is more important than your win rate. You hear people talk about these three things literally all the time in the trading industry. And like I said, I want to go over in this video simply why that's not always true. Right? Maybe depending on your trading style, this might be true, but specifically how I trade using price action, volume, and levels in the trend, right? This is actually really, really bad advice. And before you flame me in the comments, hear me out. Let me show you exactly why. Okay, so basically what I said on here, and then I'll go over into why in a second. I said, I've realized, especially the way I trade personally, it's not always true. And this may be why you're losing so many trades, is following these three pieces of advice you get all the time right here. Like I said, since I started doing this, my win rate went from around 60% to now over 80%, making me way more of a profitable day trader. I want to give you an analogy here, and then I'll relate it back to trading in just a second, okay? So let's say you have two real estate agents, right? So you have real estate agent number one and you have real estate agent number two. Both of these agents are trying to sell a house, right? That's what real estate agents do. They're trying to sell a house. They're both trying to sell the same house, okay? So we take real estate agent number one, his house commission, if he makes the sale on this house, right? He's going to make around a $30,000 commission. Awesome. So what this real estate agent does in order to sell this house, he sets out a marketing budget of $500. He sets out a staging of the house budget, right? So he staged the house, he puts furniture in it, he makes it look kind of nice, right? And he put $1,000 in there. Again, not much of a staging budget. And also the marketing budget, you know, he's got a little bit of money, but it's not that high either, okay? So basically what this means is he's going to spend $500 and $1,000. So his total risk out of his own pocket is $1,500, right? And you can kind of see how I'm relating this to trading, right? So his total risk of selling this house is $1,500 based on his budget, and his commission, so his reward, is a $30,000 commission. So this basically means his risk reward ratio is 20-1. This sounds amazing, right? This is every trader's dream, a 20-1 risk reward ratio. Well, let's go and look at real estate agent number two. Okay, real estate agent number two, she's selling the same house. She's also getting a $30,000 commission. But her marketing budget is $5,000. And she wants to stage the house really nice. She really wants to get this thing sold. She really wants to, you know, impress people who actually view the house with her. So she's setting out a $10,000 house budget for staging, okay? So her total risk with those two combined things is $15,000. So that's how much she's risking out of her own pocket, right? So basically what this means, her risk reward ratio is a 2-1. Now, the way we're told, you know, with trading, that doesn't sound as good. You're only having a 2-1 risk ratio versus a 20-1, right? So she has a 10 times smaller risk reward ratio. Now, let me ask you a question. If you had to bet money, which is what we do in trading, if you had to bet money, who is more likely to sell the house? Real estate agent number one or real estate agent number two? Well, obviously, the person who is more likely to sell the house is going to be real estate agent number two. Even though her risk reward is way lower, she's still way more likely to sell the house. So if I'm going to bet my money, I'm going to bet on agent number two because she's putting out $5,000 for marketing and she's putting out $10,000 for good pictures, staging, all the other stuff that goes into selling a house. Now, it's the same exact thing with trading, and this is where so many beginners get caught up in this advice that we get so often. And this advice, you know, I'm not going to say it's bad, but people, especially beginners, right, we kind of took it the wrong way. Okay, so here's what I mean, right? Let's say you have setup example number 1 and setup example number 2. Both the setups look very similar. As you can see, one of them worked out, one of them didn't. So let's go and break these down. All right, setup example number 1, the trade reward was 50 points, right? So you could have got 50 points. This is on NASDAQ. If you're trading NASDAQ, that's what I trade futures. So your total reward was 50 points, which the amount of money contracts I trade with, that's around $5,000. And your total risk is around 15 points. So you're risking around $1,500. That sounds good. Your risk reward ratio is a 3-to-1, but it's a decent, B- setup. Okay. Now, what most beginners tell themselves, right? And this is where so many people go wrong. And I guarantee if you fix this with your own trading, you're going to trade way better. Okay. So what most beginners will say is, oh, the risk is small, I'm going to try it, right? Risk is small, I'm going to try it. I'm sure you've said that to yourself many times in your trading. Risk is small, I'm going to try it. Why not? Now we're going to go to setup example number 2. And as you can see, we have a trade reward of 50 points. Once again, same reward, but our risk, right? Because this is actually on a 5-minute time frame, where this other one was on a 1-minute time frame, right? The risk was 30 points. Okay, so you're risking 3,000 to make 5,000. Now your risk reward ratio is 1.5 to 1 instead of 3 to 1. But this is a perfect A+ setup. We have a nice 5-minute reversal candle. We have high volume inside demand zone. To me, that's a perfect A+ setup. But what most people will say, and what I said to myself all the time when I would see a really good setup, is I would tell myself, risk is too high, I'm not going to take it. But once again, if you had to bet money, which trade is more likely to make you money? Which trade is more likely to work, right? The B- with a 3-to-1 RR, or the A+ with a 1.5 to 1 RR. Obviously, once again, the trade that's more likely is going to work is the A+ setup. Just like it was with real estate agent number 2. She's more likely to sell the house. This setup that looks perfect, but it's risking more points, is the one that's more likely to work once again. Now, you might be saying to yourself, well, Chad, why don't you just only take A+ setups that have low risk? Well, you got to keep in mind, everything in trading is a double-edged sword. So the way I trade, I don't know if this is true for everyone's strategy, but the way I trade, that's not possible. You can't have a low risk A+ setup. It doesn't really exist unless the reward is really big, right? That's the only way it would work. So you got to understand, you're way better off risking $3,000 on a high probability trade, or if you're trading with less contracts, let's say $300 on a high probability trade, than risking $1,500 on 2 lower probability trades, right? You want to take the trade that has the highest probability of working, okay? Don't just take a trade because the risk is small and the setup looks decent. You want to take the highest probability trade, even if it has a higher risk. So back to what I was saying, trading is double-edged sword. You can't really have an A+ setup, a high probability trade, and low risk. That's too good to be true. So especially with my system, I don't know if this is true with everyone's system, but for me, higher the risk, higher the probability. Lower the risk, lower the probability. And the reason for this, at least the way I trade using volume and price action, when volume is super high and we have a super long wick reversal candle, that's when the probability is going to be high. But obviously, the higher the volume is, the longer that wick is going to be. And that makes it so there's more risk, right? So there's higher risk, but there's also going to be higher probability. Now, that doesn't mean just because we had one candle that has really high risk, you're going to take the trade. Again, you still want to follow your setups. You still want to follow your system, but stop trying to take the trades just because they have a low risk, right? Stop trying to take these setup example number 1s. Maybe it's on a 1-minute chart, or even on a 5-minute chart where, it looks decent, it could work, but the risks are small, so I'm going to try it. And then you get stopped out. And then you do the same thing, then you get stopped out again, right? And boom, you just lost 2 trades in a row. You lost $3,000. Instead, you could have just took the setup that had a high probability of working, like setup example number 2 on the 5-minute time frame. It had high volume, good reversal candle. This is an A+ setup. It was in a demand zone. Yes, we're risking $3,000, but the trade is more likely to work. Okay, and if you're like, well, Chad, I can't risk 30 points. That would exceed my daily max loss. Then size down your contracts, right? Instead of trading 2 contracts, trade 1, right? And now you can take double the amount of risks as far as the dollar amount goes. So don't be scared to take those higher probability trades just because the risk is higher. Because again, if you had to bet your money, which one are you more likely going to pick? Are you going to pick real estate agent number 1, that put no marketing budget, no staging budget in the house? Or do you think real estate agent number 2 is more likely to sell the house, right? Again, if I had to bet, which is what we're doing in trading, I'm always going to pick real estate agent number 2. So anyway, guys, I hope this made sense, and hopefully you can realize, go back test this and see the trades that look good, that looks like your setup, but the risk was too high and you didn't take it. Watch how many times that trade would have worked out, right? Compared to the low risk trades that you got stopped out on all the time. Okay, go back test for yourself, see for yourself. But anyways, guys, I hope this video was helpful for you. By the way, if you guys want to join my free day trading Discord community, inside of here, I post my levels every single day on the NASDAQ and the S&P 500. I also put my trade recaps, and you can network with all kinds of other day traders in here as well and ask any questions you have for us. So if you guys would like to join this community, like I said, it's completely free and open to the public. No monthly charges or anything like that. If you guys do want to join, we'd love to have you inside. All you have to do is go to the first link in the description below, or just head over to this link right here. That being said, guys, as always, I hope you have a great rest of your day, and I'll see you in my next video with another day trading lesson.